Good day, fellow investors. Everything looks good with the stock market, well, not in the last few weeks. However, from a long-term perspective, stocks have done really well the last decade and a half. But we must understand that there is a stock market cycle that happens every 30-40 years, and that is key to understand also the risk and reward of investing today. My name is Sven Karlin, have been value investing for 22 years, done really well, and I hope to continue to do the same for the next 22 years. However, each time the market did well, as it did in the last 15 years, then a bad period followed. So we have had from 1929 to 1938, this is adjusted for inflation, stocks went down 68%. 1968-1982, stocks went down 63%. 2000-2009, stocks went down 60%. And when you look at this declines, you can see that each time those followed a stock market boom. And now, if we look at the last 3 times in history over that cycle, again, from this level, yes, there can be small ups and downs, but the most likely return is another one like this. And especially if we look at P ratios, at valuations, you are now paying a little bit less over the last few weeks, but more than 30 times cyclically adjusted earnings, average earnings over the last 10 years. Each time that has happened in the last cycles, each time, as I have shown you, the returns over the next 10-15 years were terrible. And let me put this into a dividend perspective. If we look at the current S&P 500 dividend yield, it is 1.36%. Historically, dividends have been growing between 5 and 6%. We've had great demographics over the last 60-70 years, good economic growth. Now everything is a little bit subdued, high debt levels. So let me take 5% as a conservative S&P 500 dividend growth rate going forward. The start point is 75 points. If 75 dividend points grow 5% per year for the next 20 years, we are at 198 points. That means that the current 1.46% dividend yield in 20 years would be 3.6% on the current cost. So the current yield of 13,000 on 1 million invested would be 36,000 in 20 years. With inflation, you will not make much money from investing in the S&P 500, even with 5% constant dividend growth going forward. And even if you reinvest the dividends, you maybe reach 50K per year, which is just 5% on your current investment. And each time the stock market was that expensive, the returns, subsequent returns were very, very low. And usually those low returns follow stocks always only go up periods. 1920s, 1960s, 1990s, 2010s, 2020s. Of course, maybe this time is different, but the key question is what if not? Unfortunately, as many of you know, my crystal ball broke a while ago. And that is why all I can do is look at the risk and reward and then have a clear strategy. I'm not predicting a crash. I don't know whether these negative returns will happen in the next 5 years, in the next 15, 20. To me, is irrelevant. I know the risk is there and the reward is small. I don't want to take that risk and reward. So I have to have a better strategy. I have to build a portfolio over time that is focused on long-term wealth creation through owning a business. And I can do that by buying value. And now many, okay, give me some value, give me some value. No, it doesn't work like that. Warren Buffett used to compare this with the punch card. If you have just an investing punch card over your life, you'll make pretty sure that you buy great businesses at great moments in time and so build your portfolio. Because you need to now find better than 5% growth per year. And if we look at Warren Buffett's Coca-Cola investment, he invested 1988, 1989. Look at the dividend. Back then it was 2.8%. it grew 60 times. His yield on cost also exploded. And then when you are getting 50, 60, 70% yield on cost, then it's easy to reinvest. 25 years later, you buy Apple. But the key when you reinvest is also paying a fair price for a good business. Let me remind you that these prices are very high. When Buffett was buying Apple, the P/E ratio of Apple was 10. When Buffett was buying Coca-Cola, the P/E ratio was 12. And if I look at our value investing quadrant that we follow here on YouTube, the only, let's say, less risk business, good reward, is Archer Daniel Midland's, because it is a food company that I can give you a fair price. But on top of that, every stock can go even lower, and if you're a real investor, you're happy when your stock goes even lower. I'm going to show you here this chart. This is a stock, if we adjust for splits, let's say it was 12 in 1972, then it went to 2.8 or 77% down. Imagine if you bought here, you would thought this was a terrible investment. What have I done? I've lost 77% of my investment. However, let me jump to the current situation. This is Walmart. So even if you bought here, here, or here, if you're buying a great business, well, this is often the return. Perhaps ADM will not do such stellar returns, you never know, but if we look at the trend of the business, you know you can count on a decent return and 51 years of growing dividends. So focus on owning more and more of the businesses you like. Those businesses will lead you to your wealth over the long term if you buy them at a fair price, if you patiently reinvest, build your portfolio, and you buy low-risk, good-reward investments. This will not affect you over the long term because even if it goes down, you'll have the liquidity, 5% ADM dividend yield, to reinvest, build your portfolio, so you must calculate the risk and reward when it comes to investing. That's what we do on this channel. Thanks for watching, and I'll see you in the next video.